Hey everyone, so this is going to be a summary of key points from ICT's Market Maker series. I do recommend going through the full list of videos. I'll link those in the description for you to check out, but this is just my interpretation of some of the key factors that make up that series. So to get started, stop levels are a central theme to this content and ICT methods as a whole. They represent price levels where you would expect the average trader to have a stop loss. And it's important to be aware of because the idea is that stops get attacked for purposes of liquidity. And what this means is that as price cuts through a big level, like this one right here, the market is flooded with stop orders to close positions, and in turn, smart money can use that liquidity to accumulate their positions at relatively cheap prices to send it back up in the other direction and distribute at higher prices. So if you were long somewhere in here, it might be reasonable to have your stop at this level, and now as the market takes that out, you're forced to sell your position for a loss. However, what you're selling is what smart money is essentially buying and accumulating down in this area here. And this is pretty much the foundation for directional bias is, where is price drawing towards on the daily, weekly, and monthly charts? Essentially they're always looking for some pool of liquidity, whether that be lows or highs. And so the market will take out short-term sell stops on the way up to higher time frame objectives, and vice versa if we're in a bearish market, taking out buy stops. And that's because those stop orders will be accumulated by institutions who are looking to buy at cheap prices. If we wanted to run through this chart right here, we could say that after this price leg up, there are some stops resting down below this level right here. Price comes right through that and trades back up, so we can assume that that was some accumulation going on. We create some higher lows right here, finally break structure in this area, sending price higher, come back down, retest the daily order block. We'll kind of zoom into this area to see what was going on over here. But after that, if we expect a reversal here, then we can expect that price is also looking for some higher time frame liquidity, which what could that be? It could certainly be this level right here and ultimately this level here. So to give some more context on what would be a high probability move in some of these accumulations, we can look to order blocks. So an order block is the consecutive down close candles before a bullish move and vice versa. When the underlying narrative is bullish, down close candles should hold as support, and therefore in a bearish market, up close candles should hold as resistance. If the market is bullish, then down close candles that have a market move away from it, aka right here, we have an order block right here, and has a swing low just above it, these stops resting below right here. Both of those things create a confluence of factors that make for a high probability reversal at the order block. So in this case, it's only one candle that makes up the order block, but say if we had traded back down here and took out some stops, we could say that these two consecutive candles make up one order block. Now, another topic that's covered in the series is the market maker buy and sell model, abbreviated MMBM or MMSM. And so if we're looking at a market maker buy model in this case, we see a breakdown from an initial consolidation zone, which would be right here. We see a move lower, some more chop in this area. The second distribution zone can retrace to the initial consolidation before heading lower, and in this case it does, but it doesn't always have to. And then as it breaks this zone and moves lower below these stop levels, and as price comes below those stops, we want to be anticipating a potential smart money reversal that should be way less in duration compared to the initial consolidation right here. And if we look at it, it's very clearly less than half of the time it took to get through this consolidation right here. And by the end of the smart money reversal, price should be in a rush to get to the liquidity objective, which would be these highs right here, and ultimately the higher time frame targets that aren't shown on this chart. And by the end of the smart money reversal, price should be in a rush to get to the liquidity objective, which would be up here, these buy stops resting above this old high, and ultimately some higher time frame targets, if there are any. And you can see that's exactly what's happening as we have some really strong pushes in price all the way up until this level is cleared. And this is what that previous chart is based off of, just in the other direction. This is a market maker sell model where you have some stop hunts occurring along the way here, a higher time frame market structure break, and ultimately some stop hunts and distribution and covering right around below the original consolidation. Another thing that's covered in this series is the smart money technique, or SMT, which is a divergence between highly correlated assets that suggest potential reversals. And it's not meant to be used as a tool to time the market, but rather as a confirmation, another factor of confluence that can add to your narrative. Because clearly divergences will appear all the time, but they don't really mean anything without a higher time frame bias. So here, again, we're looking at the same chart, just zoomed in a lot more. We have NASDAQ futures on the top, S&P on the bottom. We create very slightly lower lows, so this isn't the best example, but we had these lower lows in the smart money reversal area after price had already taken out short-term sell stops. And then on the S&P chart, we do have higher highs in this area. So that's something to look for as potential SMT that could hint to, what's going on as far as the smart money reversal and accumulation to potentially go long. Now, this is just another example on the 4-hour chart of some higher highs here, lower lows. It's a little easier to see than the last example. So, if you were to spot something like this where price did reject this level on both time frames, you could see that as a potential smart money reversal, and price could be gearing up for a leg lower. And similarly, if we're looking at a bullish scenario, you can see at the bottom of this chart, there's some very, very slight lower lows and, some more obvious higher highs up here for when price eventually takes off to the upside for a little bit. And one of the last topics that were covered in this series was the day of the week. So there's a 70% chance that the low of the week occurs on a Monday, Tuesday, or Wednesday. If we're in an expectedly bullish week and our higher time frame bias is bullish, then we're interested in buying below the opening price on Monday, Tuesday, and Wednesday, which the opening price in this case would be midnight New York Eastern Standard Time. And Thursdays and Fridays, not as much. We would potentially see some distribution on these days. But a potential model for this would be, if we're bullish on the week and our higher time frame bias is bullish, and Monday proves to be a fairly strong day, then we could look for buying opportunities on Tuesday. For example, if price took out some short-term sell stops, whether it's from Monday or from the week before, and reverse in the other direction, then we could potentially look for some optimal trade entries to get long. And in fact, the example that we've been looking at this whole time, the low of the week did occur on a Tuesday for what we expected to be a bullish week, given our knowledge of the market maker buy model. I just wanted to add this chart at the end here because this was a really good description of that previous slide where, price is likely to create the low of the week on a Monday, Tuesday, or Wednesday, often a Tuesday, as you can see from this chart here. So what we were actually looking at this whole time was the low created right here. Before that, we had a low on Monday, then Tuesday, 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 and now we see, the caption of this tweet by AM Trades on Twitter was that there was a change in price delivery because now the high of the week was created on a Tuesday and we closed at the lows, instead of this whole time up where we would have a low of the week on a Monday or Tuesday and close right near the highs. So we can see that price is shifting into a potentially more bearish scenario right now. But that's all I had. I hope that helped. Again, I would highly recommend checking out the original videos by ICT himself. I just wanted to make this to share some of what I thought were some pretty important points from that series. But again, I hope this was helpful, and I'll see you in the next one.